Good morning, everybody. Welcome to another episode of There's Insurance for That. We are your hosts. My name is Nate Brown.
And I'm Edwin Moreno, and today we're going to be talking about tax-free retirement with an IUL, right? So which is like, I hear IUL, I'm not really, I have no idea. I thought you were talking about a university. I was like, oh, IUL, oh, IU, oh, IU? I'm like, no, IUL. I'm like, oh,
It's
okay, that's a whole, what does it stand for? What does IUL actually stand for?
it stands for Index Universal Life. And so,
Oh,
yeah, we're gonna have a school. I got a presentation. I'm gonna take everybody to school today a little bit, and we're
cool.
gonna go through the bare bones of this because there's two types of. A lot of people don't understand that you're gonna be taxed for the rest of your life in every financial vehicle that's out there other than an IUL and a Roth. That's it. Any other means of whatever income you're going to have in retirement, you're going to be paying Uncle Sam. Doesn't matter how big your investment portfolio is, don't matter how big your 401k grows to. Honestly, sometimes your 401k can grow so large that by the time you start taking disbursements out, it becomes a tax bomb because you're like, oh, I got to take this out and it's taxable income. I done grew it up to multiple six figures, seven figures, and now I got a bigger nest egg for Uncle Sam to say, give me that. And so there's other vehicles out there, but today we're going to touch on just one of them. To You want to have this in your portfolio if you are younger and you're starting to think about retirement. If you're like 55 and up, you may want to look into other means. I'm be honest because there's a cost. This is an insurance-based product. So the younger you are, the better it is for you. Or if your income is sustainable and you have a good 10, 15-year time horizon before you plan on retiring, then this might be ideal for you. But
Okay. So just to clear and just to like, because I think you said this, but I want to make sure. So this is a life insurance policy.
mhm,
And like our last episode, if you haven't seen it, where Nate talked about the difference between whole life and term life, right? Term
yeah,
versus perm. The way you said, I love the way you said that. That was really dope. So that's one episode that you could check out, but this is like another level of of utilizing life insurance, like what you were saying, like a tax, like a vehicle to support you, so you're not being taxed on everything that you have, right?
yeah,
On every dollar that you own, every dollar that should be your dollar, there are vehicles that you can
yes,
utilize so that you're not being taxed. And this one in particular, this is a life insurance vehicle that can be
yeah,
used, which is kind of cool because I'm guessing there's a death benefit too, or there's a benefit at the end too,
yeah.
in case. So it's like you get. So I'm excited to learn about this
It's
because
it's
that's
it's
like the
it's a
best
lot
of
of
both
things.
worlds. It
Yeah, I'm
sounds
gonna give
like.
a few like real client examples on this as well. So am I able to? I don't know if I do I have screen share
You're good.
capabilities here. Okay, awesome. I'm going
I
to
already. Oh
go
yeah.
ahead and share my screen and let's hope that everybody can see it here. Made a little presentation moment here. So we're gonna go ahead and view this thing in slideshow mode, where you can still see me and Edwin over here in the cut here. So yes, we're
Yeah.
gonna talk about tax-free retirement account, everybody, with an IUL. Now, this isn't the end all be all, but I like to call it a tax-free retirement supplement because you're going to get cash value accumulation, wealth transfer, living benefits, and a lot more. So this is just something to add in your portfolio. So let's just peel the band-aid off and say, what is it? Because I hear all these fake gurus talking about IUL, and IUL on social media, and they never talk about what it is. So it's a policy. It's a life insurance policy, index universal life, and it does allow for some cash value growth through equity index accounts, like index funds. So unlike other universal policies that grow cash value through non-equity earn rates, this one actually has index accounts where you're going to be growing. So in layman's terms, it just means it's an account that participates in the upside of the market, but not the downside. So that totally eliminates risk with your money in retirement. So you never lose money with an IUL. You never lose your principal. You never lose things that you are increasing as you're paying premiums per month. There's a big portion of that that is going into a sub account that is growing in index funds. So that is one of the reasons why a lot of people love this.
That's hold on. I gotta, this is like, I mean, it's a big deal because what I'm hearing you say for those listeners, if you're not, if you can't see this, if you're just listening to this, it's, Nate showed there was a slide that said money's going to index funds, right? So an index fund, and I love this because an index fund, for those that don't know what an index fund is basically, and correct me if I'm wrong, Nate, isn't it like um just to kind of like give a visual, it's like a basket that holds a lot of different businesses inside of it that are successful businesses. So it's like
Similar
you're
to the,
investing in this basket of successful businesses. And if one of the
yes.
businesses doesn't meet the minimum requirements of this fund, they take that business out and they'll put a new business in there that can keep this fund positive because that's the goal is for this fund to grow.
Absolutely. Just like index funds could be something like one of the indexes can be S&P 500. Everybody knows that. That's the top 500 companies in the country. Guess what? You can set an allocation for some of your money to participate in the S&P 500. And it's really cool because not to get, you know, nitty gritty and completely nerd out, but you can actually have choices of which indexes you want to participate in on with various carriers.
With the
So
IUL, wait a minute.
with an IUL.
Okay,
Yeah.
keep going. I'm sorry I'm
This is
sorry for
hot.
interrupting.
It's
Please keep
cool. Nah,
going.
nah, you're good. You're good. So you get a ceiling of participation and a floor. So the floor means that if the market tanks tomorrow, you're not going to lose a dime. The floor is in most carriers 0.25% guaranteed. So that means, hey, if you got stock in Apple or you got indexes in SPY and it goes down for the day or down for the month, you're at peace because you don't have to worry about that. Then you do have a ceiling of participation. So if the stock market goes up like 20%, guess what? They'll say, hey, you may not get that full 20, but you're going to get about 15% of that participation. So your cash is going to grow up with that participation, and that overage you're not going to see. However, you do get to participate in that margin. So people are like, man, I get to grow this. And at the end of the year, however high your money has grown, that becomes your new floor for next year. So that means it just continually compounds and grows up. And so we want to talk about how money grows. Some people say, I just want to play it safe. I want to put money in the bank and let it sit. And other people say, I got my 401ks and my stocks and it's just going up and down and up and down. And God forbid, when I retire, are we in a down market or are we in an up market? Nobody knows. It's risky. Then you have index funds where however high it goes up, it gets locked in. So even if the stock market goes down, your money is locked in at that 0.25. And as it starts to climb back up, so does your money. So everything starts to look like a set of stairs after a while. And that's the difference between how your money grows. So the wealthy and the educated are playing in this ballpark right here. Some are playing in here, it's literally about 80% here, 15% here, and 5% here are the wealthier. Got a big chunk of their portfolio here. Next thing is that a lot of these accounts are after tax dollars, and some, like we talked about, your 401k can grow so high that it becomes a tax bond when you pay it later, your IRAs. And then there's tax advantage plans like the IUL and like Roth IRAs. Unfortunately, I don't have a lot of time to go into that in detail, but if you want more information, send us an email at there's insurance for that at gmail.com and we'll be more than happy to answer some of this. So if you don't, want to nerd out and have a genius, I used to always ask people, if your money is here, you start off with 100,000, which line, Edwin, do you just want your money to look like? The red line, the blue line, or the green line?
But the green line is the one that catches my attention the most
The,
personally,
the
because yeah,
green
it
line
looks
is
it looks like it
it.
just keeps going up.
Absolutely. That is an IUL. These are real live numbers too, ladies and gentlemen. So this is the difference between you're just going slow and steady, slow, slow, slow. And this is the difference of honestly playing Russian roulette with your income. It's like, why would I do that? Some people only do it because that's the only thing they know to do. However, I had clients when just a couple years ago after COVID happened, I had some people that called me that had index funds through IULs and said, "Hey Nate, um, I know the market's doing really bad 2022. Do I gotta worry about anything? Because I'm retiring like 4 more years." I said, "Nope, your money's safe. You have an IUL. You're good. You're good to go." And they were like, "Whew, okay. I just wanted to double check. I remember you telling me that, but I just wanted to make sure." I said, "Nope, zero is your hero. Guess what? If things are going down, your money's gonna just level out and you're safe." And so they're like, "Oh, okay, thank God." And so here's another perk, everybody. Here's another perk to an IUL. Do you know that when you start to take money out of your IUL, you never have to pay taxes on it? Yup. Got to know your IRS codes. IRS code 7702, section A. I have the layman's version of it and the actual tax code law. In layman's terms, it just says when you take money out in the form of a loan from your IUL cash value, you never have to pay taxes on the financial growth ever. So this is where it becomes tax free. So I'm gonna if you're a numbers person, I'm actually gonna show you exactly what this looks like in just a couple more slides. So here are the benefits. Your money grows tax free. Your money is safe from market volatility. It's a life insurance, so it has all the bells and whistles of a life insurance. It has a death benefit. So if you pass away, your family gets a big pile of money. You have living benefits. If you get sick or disabled in the process of you aging, guess what? You could take some of that money and live with it tax free as well. And then you have wealth transfer to spouse and children. So your money is literally taking on three uses instead of one. You have compounding interest over time. If you ever heard Einstein, he says, "Hey, you're either gonna," he said, "compound interest is one of the eighth wonders of the world." And other people say compound interest, you're either going to be paying into it or not. So you want to be paying into it and not giving it away to someone else. So you never ever lose
Hmm.
your principal investment, which gives you peace of mind. Most people don't play the stock market or they're scared to do things because they're worried about losing their peace of mind. And so I like to say, don't let,
Before you go to the next one,
okay.
can I
I'm gonna
just
go too fast.
can
Yeah,
I
go
just
ahead.
like really quick. I want to talk about the compounding because you mentioned compounding a couple times, and some people don't even know what like that means. Like compound. Like,
Mm.
are you talking like a compound, like where you live in a compound? Are you talking about like and and again, it's just kind of like I really want, I grew up in an environment where, you either worked at McDonald's, you worked at a retail store, or you became a doctor. There was really no in between, right?
Hmm.
And and so throughout my life, I've learned, oh wow, there's more. There's different types of careers you can have. There's different types of things, there's different type of ways you can put money away. I mean, even this
Yeah.
tax vehicle, like this is something that's new, I'm sure to a lot of people. And even the law of compounding, I had to learn that later on in my life, right? In the later years of my life, when I learned about, oh wow, the law of compounding, like this is a really important law that everyone should know. And so can you kind of like just what does compounding mean? Like what does that like if someone is using this, like someone says, "Hey, I want an IUL," but it's just like the compounding part, like what is that? Like what does that mean?
Man, I have another presentation with a cool slide on that. I may pull it up or may send it to those who can visually see this. But let's say, for example, you have $100,000. I don't know if you can see my calculator with this, the way this thing works, but let's say you got $100,000 dollars, and if it's just sitting in your mattress or underneath in this Nike box for 5 years, 10 years, guess what? With inflation at 3%, if your money's not growing at least at 3% or more, let's say 10 years later, that, $10,000 or $100,000 is not as valuable as 100,000 anymore. It's probably closer to 87,000 in real value because the cost of the price of the dollar or the value of the dollar has dropped. However, if you're
Right,
compounding interest, which means, hey, I put this 100,000 in something that's earning 6%, 5%, 3%. So I will say this, let's say, I always say, let math be your friend. So let's say 100,000 times 5%. That's an additional $5,000. So now you have 100,000 and $105,000 just from putting your money in a different vehicle. or put it in a better parking space. So instead of parking it at a bank
Oh, so
where
now I'm
you're
gonna get
putting 0.03% in your checking account or savings account, or even a CD where you're probably getting 3.75, which isn't a bad situation. But some of the IULs I do for my clients, they're growing at 6.83%, and then they have that participation in the market where they may experience 9%, 10% of growth, cash value growth. And so if that's your new balance at the end of the year, you now have $105,000, let's say 105,000, and then you times another 5%. You just earned 5,250. So you add that to your $105,000. And now just from parking it there, you now have $110,250 in 2 years
wow.
versus just 100,000. So some people say, I just want to put my money safe and I'm
I
so afraid. I'm not going to put it anywhere. But you're actually losing by not putting it, parking it in the right type of area where you can actually grow compounding interest, where it's just going to grow and grow and grow and grow and grow throughout perpetuity. And that's where the wise and the wealthy of America are parking their money. This is one of the places where they're parking their money at.
Right. So you
Oh,
heard it here, folks. Like this, like Nate just dropped. I mean, like one of the biggest gems so far in our like. There's assurance for that. Just history, career so far of us like building this. And I mean, no, for real, because this is a big deal for people to understand just the law of compounding and the power of compounding. You had 100,000, and now instead of you're getting 5% on 100,000, you're going to get 5% on 105,000. And then next
yep,
time you get 5% on 105,000, now you're getting 5% of 110,
10,000.
115,000. So we're talking about like you're just getting 5% on top of 5% of what keeps accumulating, of what keeps building,
Yes,
what keeps building. I
yes,
mean, that's wild to consider that you can like
yes.
turn that $100,000 into $1 million potentially,
Oh yeah.
all through compounding, all because,
Oh, check.
all because of
Mm.
this law of compounding. So I just wanted to like this is actually, yeah, I think that was really important. So please continue, Nate. I apologize again
No, no, no
for
apologies. I
interrupting.
love it. I love it. I'm gonna now put some numbers in here. Hopefully everybody can see this. It's not the real Mario, but I just had to pick a random guy for compliance reasons. But let me go into Mario. I'm sorry. So Mario, hey, where'd it go? Mario was a business owner. He had a daycare and he was doing pretty well for himself. He's only 38 years old. And he said, dude, I want to start putting $1,000 a month, 250 a paycheck into an IUL. He was in position to do that. I said, okay, cool. Let's do an illustration and show you what it's going to look like. So I showed him if the market tanks for the next 20, 30 years, you're still getting 0.25 at the end of every single year. So that's your guaranteed assumptions. And then here's your median of, the better version of your interest yield. So here's the median, is 4.75. Here's what you're expected to get based on market value participations. And so we have your account value, which is growing compound interest. We have a surrender value, which is the same thing as your cash value account. You can use this money tax free whenever you want. And then this is the death benefit that is going to go to Mario's 2-year-old daughter who is growing every single year. So I want you to pay attention to a few things here. He's putting in this number here, every single year as a retirement supplement, right? And you just see these numbers here earning compound interest, growing and growing and growing. I want to point out to something. Let's say this is year 20 of his policy. He's 58. He wants to retire soon. He's put collectively $240,000 in here. However, he has access to 434,000 tax-free dollars. It's just compounding way
Hmm.
more than what he put in. And if he passed away at 58, his family gets this whole big amount. So we're talking over $1 million, right? But I want you to pay attention to something.
Hmm.
Let's say at 64 years old, he's retiring next year. He says, hey, I don't want to make any more contributions to this plan. I want to relax for a year, and then I want to start having it pay me back. So I want you to see this here. He's taking out $72,000 to supplement his retirement every single year now, tax free. And I want you to pay attention to this next slide here. I'm sorry, I was sitting there, I'm talking it, but not selecting the right buttons here to get this part going. So this is what he's contributing.
Gotcha,
This is
gotcha,
his
gotcha.
cash value that is growing, growing, and growing and growing. Death benefit is over $1 million at this point. But I want you to see 72 grand in tax-free retirement. Just look, he put in a total of $312,000. In just 3 years alone, it's paid him back 218,000 tax-free dollars. Let's go to the next slide. And I just illustrated just to age 90. It's paying him 72 grand every single year. He only put in 312. It's already paid him back 945,000. He only put in 312. It's already
Wow.
paid him back 1.672 million. And that's on top of his social security, whatever other type of things he may have done. This is just a tax-free payout that comes. This is more than most people's income is in retirement. Literally. Some people are working and never see incomes like this. He is getting compounding payouts now over and over and over. And guess what? He still has a big surrender value here, cash value. As you see, it starts to deplete some. But his main thing is I want to supplement my retirement. So let's say, for example, if he
Right.
passed away at any of these ages, his daughter's still going to get, multiple six-figure payout. Um, if he stops contributing to his tax free, guess what? That compounding money just starts to build back up again. He can still pull from it however he wants to, and his death benefit continues to grow. So this is a supplemental tax retirement vehicle. And just for kick, somebody said, "Well, he was 38 and he's putting a lot. I don't have $1,000." That's totally understandable. I want you to think about your children. So he was putting aside $200 a month for his child. Again, I know somebody was doing $50 a month, whatever you can do. I want you to look at some of these numbers here. Let's say, for example, his daughter is now 25. You know, maybe she's just finished college a couple years ago, maybe wants to put a down payment on a house or car or something. She has tax-free 139 to $151,000 that she can use to do that. However,
Wow.
she went to college. She's okay. She's doing all right. Let's just look at what her. I'm sure most parents would say at some age, "Hey, daughter, you now have to pay $200 a month into this plan. I'm not going to keep paying it for the rest of my life." But I want you to see something. I want you to see her retirement age. Let's say 65. She's 65 and she now wants to retire. Just follow along with my mouse. Can you imagine having 2.5 million tax-free dollars in retirement for something your dad started when you were 2 years old? Crazy.
Hmm.
Crazy. Earning 7.23% on average every single year. Look, she's making almost $200,000 a year in interest. Almost 180 something thousand in interest. She can pull out 180,000 every single year and still have 2.5 million for the rest of her life. Literally, like done.
Wow.
And she can even do this earlier in age. She can even retire early if she wants to. I mean, goodness gracious, I'm almost 45. And at 50, she's at, 843,000. She's a millionaire at 53 years
They're
old.
almost $1 million. You
She
almost
can
got $1 million
legit
away at 50 years old, just
She can
chilling.
pull out 5% of that every single year and live like a queen and retire young because of something that was started. So again, this is just information that I wanted to share. This is one way that generational wealth is started and that trust fund babies get created. This is just one way. There's other ways, but I want to just at least educate the listeners and the watchers on this particular way. And so I'm not opposed to 401ks. They're there. They even the owner or the creator of 401k said it's not the best thing that he's ever thought of. Like it's not really the greatest thing. But I just want you to compare these real quick. You got no guarantees here. You have guaranteed growth here. You got variable index ups and downs. You have index funds that only has the ups. You have to pay taxes on retirement, and you have tax advantages in retirement from IRS codes. Right here, your money is subject to market losses. Right here, you have principal protection. So you're not losing any money. This one has age rules. You can't touch your money without a penalty until you're 59 and a half years old. You can touch your money whenever you need to if it's in your cash value account. So no additional death benefits. Like, you know, once your money's gone, it's gone. That's it. This one you have additional death benefits. There's no living benefits here. You have living benefits here. So it's just something that has evolved over time. So I want to just, again, I'm gonna stop sharing at this point after this last slide. 78% of most Americans go back to work after retirement because they have to, not because they want to. And so I just want to encourage you, don't put it off and find a way to secure your retirement. So this is how some people retire with a have it create a tax-free income account with an IUL. So there you have it. Try to make it
Appreciate
short, sweet,
appreciate the information.
so I want to leave one
Very,
last
very
thing.
valuable.
Yes. So some people say, how much do I put into this? There is a there while there's no perfect number, we want you to do something that's comfortable. But if you're being aggressive in your retirement planning, I would say one rule of thumb is to 10x your age. So if you are in your 20s, the cost of insurance is super low. You know what I mean? And in our 20s, we'll go out for a weekend and spend 300 bucks on fooling around. But if you're wise, if you're in your 20s, maybe try to put 200 bucks into an IUL. Maybe factor it out, a $50 a paycheck if you get paid every week, and structure it that way, and just let it ride out. Lock in at that rate. And it's also the universal part means you can change it over time. So if you do have a hardship in life, you can bring your premium down. If you get a bonus at work or get a raise, and you want to raise it up and stockpile some more, you can just do a phone call and say, I want to up my plan. So you can do that as well. If you're in your 30s, you may want to do 300 bucks a month. If you're in your 40s, 400 bucks a month. If you're in your 50s, you may be looking at the fives, only because the portion of it that is life insurance does cost a lot more in your 50s. So, but after 55 or so, you may want to look into maybe some type of Roth conversions or something like that from accounts that you may have hopefully built up by then, because you do not want to be stuck with just Social Security as your only income. You'll retire poor, and you'll have to go back to work instead of having
Right,
the option and the
right.
choice to say,
Well,
I have supplemental income coming in tax free.
yeah, I also want to highlight too, like, some people, some people got their 401k and it's like, I don't think this is like a don't get a 401k type of thing, right? It's like, yo, that's what you have, that's what you have. And there are other vehicles that can be utilized so that you're not getting taxed at you're not getting taxed for everything, for all the work that you've done, right? For everything that you've put away. So I really want to put emphasis on like the vehicle aspect. And it's like this is another vehicle that you can utilize because there are many vehicles that can be
Yes.
used to support you in your retirement. And this is a great tax-free move that you can make. And even like I think as a young individual, like what you said, it's like there's a lot of people purchasing homes. There's a lot of people like they're making investments. And a question that I wanted to ask you before we close off was, like, how many of these life insurance policies can I get? Like, is there a limit to how many I can get?
No, no, we can have as many as you like. That's another option. As many as you like, as many as you can afford. Or to be honest, if you have a good one, you have to have a good company. I will say that
Right,
some companies have an IUL option, but they don't have horrible indexes. You may have 2, 3% indexes. That's
right,
as a CD. Some of the ones I showed you are some of the A-rated carriers that are out there that you saw the indexes were hitting at 7% and things like that on average. So you want to look into, do your homework on your carriers or reach out to us. There's insurance for that at Gmail. We can put you in a position to be with the carrier that is going to give you the optimal performances on your money that you need. So there are a few out there that the wealthy like, because they know that this particular company or two or three of them are going to give you a higher interest yield.
That's key. That's key. A lot of and these companies have been around 100 years, 80
Yeah,
years. Like these companies have been around for a long time.
yeah,
So these people that are choosing these carriers because they know, hey, this company's financially stable. They've been around for a while. They have a great reputation. And unfortunately, there's a lot of promotions, there's a lot of advertisements, there's a lot of things like, retire this, that, do this, do this, do this, do that. And then, you're actually putting money in a mutual fund, right? Like you're actually putting money in something that
yeah.
that it's a real estate mutual fund, and you're like, oh, wait a minute, like I thought I was in the this kind of, what is an index fund, but it's for only real estate. That could be kind of risky, right? So it's like it's kind of like looking like what you said, Nate, like asking the right questions and reaching out. There's insurance for that at gmail.com. It's a great place for you to start and just like get the information, be informed. That's really what this channel is about, for you to be able to learn and make um um just make conscious decisions on the money that you're putting towards your family, for yourself, for your business, and we are licensed professionals that take pride in offering great products, right? Because we also
Absolutely.
we purchase these products ourselves. You know what I mean? So it's like these are things that we yeah, that it's really important for us. So hey, I mean, man, Nate, you dropped so many gems. I think the main thing was that, like, I just wanted to know how many policies can someone purchase, because I think people get caught up with like, oh well, like I got to start at X amount. It's like, look, if you're in your 20s, start lower. Like start lower,
Absolutely.
you can add more to it, or guess what? You can get another policy.
You can. Yeah, you can add to it. You can get
You
another
know,
one. Um, you can just, I like that part about the IUL, that is flexible. So you can, make increases to it as needed, when you need to. So that's another feature. So if you did start out in
right?
your 20s and you just say, hey, I want to add to it, or I've had people say, hey, I need to pause my contributions for 3 months. My job is downsizing. I don't know what's going to happen. And say, okay, cool. We can adjust that for the time being. Or we can say we can keep your policy premium alive with, we could use some of your cash value just to fund your premium for the next 3 months or something like this. So many options that are out there because they want you to
Right.
maintain your policy and keep it. They don't
Beautiful.
want you you know, to default or
Right.
lapse it.
Well, because that's the
And
way it's going to grow. Right. That's the only way
absolutely.
it's going to grow, and it's going to benefit you. It's going to benefit you if it grows. So like you don't want it to lapse. You want to make that a priority. So hey, that's our time.
Oh,
That's our
good
time for
point.
today. Nate, thank you so much for this information, Nate, because people charge thousands of dollars for this kind of information.
They do. But we giving out the game because we want to see
Give
people succeed for sure.
that's that's no gatekeeping. That's what it's about. We really want to embrace that, because we've been gate kept a lot in our careers, and
Yes.
and we don't like the way that feels. But Nick, you wanna close this out, man?
Hey, thank you all for watching. Continue to hit that like button, share this, follow, comment, all that stuff. We love the interaction. If you got questions, throw them in the chat.
Subscribe,
Make sure you
subscribe. We're
hit
almost
that.
get to the
Yes.
100.
Yeah, we're trying
Subscribe.
to get to 100 subscribers. We're a new channel. Let's go and let's grow. Y'all have a good one. Stay tuned to the next episode of There's Insurance for That.